Welcome to the Deep Dive, where we crack open complex topics and give you the essential knowledge you need to master them.
Hello?
Today, we're plunging into a subject that often feels like, well, an impenetrable fortress, tax law, especially when it crosses international borders.
hmm
But don't worry, we're not just peeking through the keyhole. We're taking a full-blown deep dive into non-resident taxation.
That's right. And this isn't just abstract theory. It's a really crucial area for anyone involved in global business, international investments, or, frankly, just navigating a life that spans different countries.
Absolutely. And to guide us through every twist and turn, we've got a comprehensive stack of material, a detailed revision lecture, and its accompanying study notes.
Think of it as your ultimate guide. It's meticulously designed to ensure you understand every concept, every nuance, especially for those tricky application-based questions you might face.
So our mission for you today, the curious learner and hopefully future master, is to unlock every single concept and specific detail of non-resident taxation. We'll be following the material strictly in order.
Exactly.
Yeah.
We're going to break down complexities, clarify definitions, and really spotlight those minute details that can make or break your understanding, particularly if you're gearing up for an application-based exam.
This deep dive is crafted to be a complete exam-oriented summary. We want to ensure you miss nothing, understand everything, and gain true mastery. So let's unpack this foundational area.
Okay, to start, let's establish the absolute bedrock of non-resident taxation, residential status.
Right.
Now, this is a concept often confused with citizenship, but they are fundamentally distinct things. Your citizenship, well, that defines your nationality. But your residential status, as defined very precisely under Section 6 of the Income Tax Act, that dictates your tax liability here in India.
And it primarily revolves around how many days you spend here, right? Though, as you said, there are some critical income-based twists we need to explore.
Exactly. It all starts with the individual, specifically Section 6, subsection 1, which lays out the basic conditions for being considered a resident in India. And you only need to satisfy one of these two conditions. The first one is pretty direct.
Yeah.
If you've been in India for 182 days or more during the relevant previous year, boom, you're a resident. Simple as that.
Okay, 182 days. Straightforward. But what if you don't hit that number?
Well, if you don't hit that 182-day threshold, there's an alternative path to residency. This is the second basic condition.
Right.
And this one comes with two requirements, and they're cumulative. You must have been in India for at least 60 days or more in the relevant previous year.
Okay, 60 days minimum in the current year.
And you also need to have accumulated a total stay of 365 days or more in the 4 immediately preceding previous years.
So a look-back period here. 60 in the year plus 365 in the prior 4.
Correct. So just to reiterate, satisfy either the 182-day condition or this 60 plus 365-day condition, and the individual is considered a resident in India.
But knowing tax law, there must be exceptions, right? Especially to that second condition, the 60-day rule.
You guessed it. There are significant exceptions. For certain individuals, that 60-day rule, it just doesn't apply. Their residency is solely determined by the 182-day rule. They simply cannot use the 60-day plus 365-day look-back.
Okay, so who falls into these specific scenarios? Who only looks at the 182 days?
Right. The first scenario involves an Indian citizen who leaves India during the relevant previous year.
Okay.
But this exception applies only if they are leaving either as a crew member of an Indian ship or for the specific purpose of employment outside India.
Got it. Indian citizen leaving either as ship crew or for employment abroad, only the 182-day rule matters.
Precisely. And the second exception, where the 60-day rule is also set aside, is for an Indian citizen or a person of Indian origin, or PIO.
And PIO means?
Defined precisely as someone whose parents or grandparents were born in undivided India. So if such a person who is normally outside India comes to India on a visit during the relevant previous year, for them too, it's generally the 182-day rule that determines residency.
Okay, so visitors who are Indian citizens or PIOs, generally also just the 182-day test.
Generally, yes. But, and here's where we hit a really crucial nuance, a layer that often tricks people up in exams.
Ah, okay. What is it?
Even for that second exception group, the Indian citizen or PIO visiting India, there's a special rule that kicks in if their Indian income is high.
High Indian income changes the rules. How high?
If their total income, excluding income from foreign sources, exceeds 15 lakhs during the previous year, then the number of days required for residency shifts quite dramatically.
Wow, okay. So a change in income completely alters the calculation for residency. What's the new threshold then in this specific high-income scenario?
In this specific scenario, such an individual, an Indian citizen or PIO visiting India with Indian income over 15 lakhs, will be treated as resident in India if their stay in India is 120 days or more in the previous year.
120 days.
And they've also been in India for 365 days or more in the 4 immediately preceding previous years.
Okay, so for this specific group, the high-income visitors, it's 120 days in the current year, plus the 365 in the last 4. Not 60 or 182 for the current year threshold. That's very targeted.
Very targeted, yes. Now, beyond physical stay, we encounter this powerful concept of a deemed resident under Section 6, subsection 1A.
Deemed resident, it sounds like you can become resident without even being here much.
Essentially, yes, it's a deeming provision. An individual is considered a deemed resident regardless of their actual physical presence, just by meeting specific criteria.
Okay, what are the conditions?
The conditions are precise. The individual must be an Indian citizen and have a total income, again, excluding income from foreign sources, exceeding 15 lakhs during the previous year.
Okay, Indian citizen income over 15 lakhs.
And this is the crucial third leg. They must have no tax liability in any other country or territory because of their domicile, residence, or any similar criteria.
So it catches individuals who are Indian citizens, earn significant income from India, but aren't taxed anywhere else.
Exactly. It casts a wide net to capture those who might otherwise fall through the tax cracks globally.
And what's the consequence of being a deemed resident?
The significant consequence under Section 61A is that they will always be treated as a resident, but not ordinarily resident, or R&R.
Always R&R. Got it.
It's also vital to remember if an individual is already a resident under the general conditions of Section 6.1, the 182-day or the 60 plus 365-day rules, then this deemed resident provision simply does not apply to them.
Right, it's a fallback or a specific anti-avoidance measure, not an override if you're already resident by stay.
Correct. Now, there's also a very specific provision in Rule 126 for computing the period of stay, just for crew members of ships.
Okay, what's special about ship crew?
For an Indian citizen who is a member of the crew of a ship, the period of stay in India, for what's called an eligible voyage, shall not include the period starting from the date they join the ship, as recorded in their Continuous Discharge Certificate, or CDC,
Okay.
right up to the date they sign off, also as per the CDC.
So even if the ship is in Indian waters or docked at an Indian port during that time, that specific period from joining to signing off is excluded from their residency day count.
Exactly. That specific time is excluded. An eligible voyage is clearly defined too. It's a voyage that either originates from India or ends in India.
Right. But any other time they spend in India outside of that specific voyage period is included.
Yes, all other periods of stay are included in the computation.
Yeah.
It's a nuanced detail, but definitely relevant for exam questions involving seafarers.
Okay. So once we've determined someone is a resident, either through the basic stay conditions or by being a deemed resident, what's next? You mentioned further classification.
That's right. Once an individual is determined to be a resident, they are then further classified. This second classification determines whether they are a resident in ordinarily resident, ROR, or resident but not ordinarily resident, RNOR.
R versus R&R, and this distinction is critical. Why?
It's absolutely critical because it directly impacts the scope of their taxable income, particularly how their foreign income is treated.
Got it. So how do you become RR?
For an individual to be classified as RR, they must satisfy both of two additional conditions. Condition 1. They must have been a resident in India in at least 2 out of the 10 previous years immediately preceding the relevant previous year.
Okay, resident in 2 out of the last 10 years.
And condition 2. They must have been physically present in India for a total period of 730 days or more during the 7 previous years immediately preceding the relevant previous year.
730 days in the last 7 years. And you need both of those to be RR.
Both must be met. If a resident individual does not satisfy both of those RR conditions, then they automatically fall into the RRR category.
Okay. And you mentioned earlier anyone who is a deemed resident under 61A is always R&R by default.
That's correct. RNOR is also the default status for a deemed resident under Section 61A. Understanding this RNOR distinction is paramount, as it dictates whether worldwide income or a more limited scope is taxed.
Let's run through a couple of examples directly from our source material. These really help solidify the concepts, and they feel like prime application-based questions.
Good idea.
Let's take Mr. Chris Gale for the assessment year 2025-26. His stay in the previous year, 2024-25, was 102 days.
Okay.
And his stay in the 4 immediately preceding previous years totaled 408 days.
Right.
So since his stay of 102 days in PY, 2024-25 is more than 60 days. And D, his aggregate stay of 408 days in the 4 preceding years is more than 365 days.
He satisfies the second basic condition under Section 6.1.
Exactly. So he's a resident for AY 2025-26. Now, to figure out if he's RR or RN, we'd need more info, right? His historical stay data for the last 7 and 10 years.
Correct. The example just establishes residency based on 6.1.
Okay.
Now let's look at Mr. Sharath. He's an Indian citizen visiting from the West Indies. We need to see how his income level changes things.
Okay.
Scenario 1. His stay in PY 2024-25 is 102 days. In this situation, he would be treated as a non-resident.
Regardless of income.
Regardless of income in this case. Why? Because he's an Indian citizen visiting India. The special 120-day rule only kicks in if his Indian income exceeds 15 lakhs.
Okay.
With only 102 days, he's below the general 182-day threshold that applies to visiting Indian citizens, where the 60-day rule is accepted, and he's also below the 120-day threshold, which wouldn't apply anyway if his income isn't high. So definitely non-resident.
Makes sense. Now, scenario 2.
Scenario 2. His stay in PY 2024-25 is 120 days. Now, things get interesting. Sub-scenario A. If his total Indian income, excluding foreign sources, exceeds 15 lakhs, in this case, he is resident but not ordinarily resident, RNOR.
Why RNR?
Because he stayed 120 days in PY 2024-25. And assuming he had similar visits, let's say he accumulated 480 days, 120 days, 4 years, in the 4 preceding previous years.
Okay.
This perfectly satisfies the special condition for PI's Indian citizens visiting with high Indian income, 120 days or more in the year and 365 days or more in the preceding 4. That makes him a resident.
And then the RNR status follows automatically if he doesn't meet the ROR conditions.
Correct. Or sometimes the rule itself deems him RNR in these special cases.
Okay. And sub-scenario B stays 120 days, but income is not over 15 lakhs.
If his total Indian income does not exceed 15 lakhs, he remains a non-resident.
Even with 120 days.
Even with 120 days. Because the crucial 120-day rule for high-income visitors doesn't apply here, as his income isn't above the threshold.
Right.
So the only relevant rule for him defaults back to the general 182-day threshold for visiting Indian citizens, which he doesn't meet with only 120 days.
These examples really drive home how critical every detail is. The days, the income thresholds, the specific exceptions, a small change, big difference in status.
Absolutely.
Okay, building on individuals, let's consider Hindu undivided families, or HUFs. How is their residency determined?
For an HUF, the core principle is different. It becomes a resident in India if the control and management of its affairs is situated wholly or partly in India.
Wholly or partly, so even partial control from India makes the HUF resident.
That's the rule. Conversely, if the control and management of its affairs is situated wholly outside India, only then is the HUF a non-resident.
And what does control and management really mean in this context? Is it just day-to-day stuff?
No, that's a crucial distinction. It refers to the central control and management. Think of it as the head and brain of the HUF's operations and decisions.
Okay, strategic direction.
Exactly. It's not about the mere day-to-day operations handled by employees or agents somewhere. It's about de facto control, who is actually pulling the strings, not just who has the legal right to.
So even if the HUF's business is, say, entirely outside India, if the Carta, the manager, is making the key decisions from within India,
then its control and management could still be considered wholly or partly within India, making the HUF resident. Merely having a house in India or some members living here doesn't automatically make it the seat of control unless important decisions are actually made from that location.
got it. And similar to individuals, once an HUF is resident, does it also get classified as R or RN or R?
Yes, it does. A resident HUF is further classified based on the residential history of its Carta.
Okay, based on the Carta status, how?
An HUF will be considered RN or R if its Carta was a non-resident in 9 out of the 10 previous years immediately preceding the relevant previous year.
Okay, 9 out of 10 years, NR Carta means RN or HU.
Or, alternatively, it's also RN or if the Carta's physical stay in India during the 7 previous years immediately preceding the relevant previous year has been 729 days or less.
729 days or less in the last 7 years.
So if the Carta meets the normal ROR conditions for individuals, the HUF is ROR.
Correct. If neither of those specific RNOR conditions applies to the Carta, then the HUF is considered ROR.
That simplifies things a bit. Now, what about other entities? like firms, AOPs, BOIs, local authorities, artificial juridical persons.
For those entities, the rule is significantly simpler, thankfully.
Cut.
These entities are classified as resident in India if the control and management of their affairs is situated wholly or partly in India. Same principle as HUFs.
And non-resident if control is wholly outside India. Exactly. If the control and management is situated wholly outside India, they are non-resident. And importantly, unlike individuals in HUS, there is no further classification into R-OR or R-or-N-OR for these specific entities. They are either resident or non-resident. Full stop.
That does streamline things quite a bit. Okay, now let's turn our attention to companies. This is a very significant area for international taxation, covered under Section 6, subsection 3. How does a company become resident?
A company is considered a resident in India in any previous year through one of two distinct pathways.
Two ways, okay.
Pathway 1. If it is an Indian company, if it's incorporated in India, it's always resident by definition. Simple.
Always resident if Indian incorporated. Got it.
All right.
Pathway 2.
Pathway 2. If its place of effective management, commonly known as PM, in that year is in India.
PM, place of effective management, okay.
If neither of these conditions are met, it's not an Indian company, and its PM is not in India, then the company is treated as a non-resident.
So that POM concept is obviously critical, especially for foreign companies. How is it defined?
Absolutely central. The definition is right there in the explanation to Section 6.3. PM means the place where key management and commercial decisions necessary for the conduct of the business of an entity as a whole are, in substance, made.
Key management and commercial decisions for the whole business. Made in substance. Sounds like it emphasizes reality over just appearances.
Precisely. It's a globally recognized test, often used in tax treaties as a tiebreaker rule to figure out residency and avoid double taxation situations.
Okay. And to make this determination less subjective, I believe the CBDT issued guiding principles.
Yes, comprehensive guiding principles and circulars. The primary criterion to start with, the first filter, is whether the company is engaged in active business outside India or ABOI.
ABOI, active business outside India. How is that determined?
A company is considered to be engaged in ADOI if all four of the following conditions are met. And these are cumulative. All four must be satisfied. They're usually assessed by taking the average data for the previous year and the two immediately prior years.
Okay. Condition 1.
First, its passive income must be not more than 50% of its total income.
Passive income. What does that include?
It's clearly defined. The aggregate of income from transactions where both purchase and sale are from or to associated enterprises, and income like royalty, dividend, capital gains, interest, or rental income.
Okay.
But there's a crucial exception. Interest income from a banking business or a public financial institution is not considered passive income for this specific test.
Got it. Condition 2.
Second, less than 50% of its total assets must be situated in India.
How are assets valued for this?
Fair market value on a specified date, importantly, without any reduction for liabilities. For depreciable assets, it's the average tax written down value. For others, it's book value.
Okay. Condition 3.
Third, less than 50% of its total number of employees must be situated in India or be resident in India. The number of employees is calculated as an average, including indirect employees doing similar tasks.
Makes sense. And the fourth condition.
And fourth, the payroll expenses incurred on those employees situated in India or resident in India must amount to less than 50% of its total payroll expenditure. Payroll here is broad salaries, wages, bonuses, compensation, pensions, social costs borne by the employer.
So 4 tests. Passive income, asset location, employee location, and payroll location all need to be predominantly outside India to qualify as ABOI.
Exactly. All 4 must be met.
So once you've done this ABOI test, how does that feed into the POM determination? What if the company is engaged in ABOI?
Okay, if a company is engaged in active business outside India, passes all 4 tests, then its POM is presumed to be outside India if the majority of its board meetings are consistently held outside India.
A presumption based on board meeting location? Seemed clear.
It is, but there's a vital counterpoint, an override to this presumption.
Oh, okay.
Even if the majority of board meetings are held outside India, if the board of directors is not actually exercising its powers of management, and those powers are, in reality, being exercised by the holding company or perhaps some other person who is resident in India.
Oh.
Then, despite where the meetings happen, the POM shall be considered to be in India, substance over form again.
Right. But just following, say, global policies from a parent company doesn't automatically mean the board isn't exercising its power, right?
Correct. Merely following general global policies doesn't by itself mean the board isn't exercising its own powers. It has to be a more substantial usurpation of decision-making.
Okay. Now, what about companies that are not engaged in active business outside India? They fail one or more of those four ABOI tests.
For those companies, a more in-depth two-stage process applies to find the PO.
Stage one.
Stage one is to meticulously identify the person or persons who actually make the key management and commercial decisions for the company as a whole. Who's really calling the shots?
And stage two.
Stage two then involves determining the precise place where these decisions are, in fact, being made. Where is that decision-making activity happening?
And I recall you saying earlier the place where decisions are taken is more important than where they're implemented.
Critically important insight. The place where decisions are taken carries more weight than the implementation location. That principle of substance over form is absolutely conclusive here.
So just holding board meetings somewhere doesn't cut it if the real decisions are happening elsewhere, like at head office.
Exactly. Formal meetings aren't enough if the key substantive decisions are made elsewhere, maybe at a head office, maybe where the company's main activity really happens.
Okay, let's really dissect the specific factors that guide this POM determination, always looking through that substance over form lens. What if the board delegates authority?
Right. If the board delegates its authority and maybe just routinely rubber stamps decisions already made lower down, then the POM is likely where those senior managers or other influential people, could be a key shareholder, a promoter, even an outside advisor, are actually making those critical decisions.
And senior management here means?
People like the MD, CEO, CFO, COO, heads of major divisions.
Yeah.
Those responsible for developing strategy and overseeing execution.
Makes sense. What about executive committees?
Similarly, if powers are delegated to an executive committee, the location where its members are primarily based and where they formulate those key strategies before formal board approval, that location is often indicative of the PWOM.
And the head office location itself?
That plays a significant role too. If senior management and their key support staff are all in one place, and that place is held out as the main place of business, that's usually the head office and a strong POM indicator.
What if the company's more decentralized?
For decentralized companies, it's more about where the senior managers are primarily based, where they usually return to, or where they consistently meet to hammer out key strategies. If it's too decentralized, then the head office location itself becomes less relevant in the POM puzzle.
And with modern technology, physical presence isn't everything anymore, right?
Correct. Physical presence is less critical. So the place where the directors or the key decision makers usually reside can be a highly relevant factor in determining POM.
What about decisions made by circular resolution, like emails or voting without a meeting?
For those, you look at the frequency, the type of decisions being made that way, and the location of the parties involved. But the focus always remains on who actually has and exercises the authority to make the final decision.
Are decisions made by shareholders relevant, like selling off a big part of the company?
Generally, no. Decisions reserved for shareholders, like major asset sales, dissolution, changing share rights, these usually affect the company's existence or structure, not the day-to-day conduct of its business. So they're typically not relevant for POM.
But there's an exception.
Yes. Shareholder involvement can become effective management if they actively restrict the board's authority and effectively take over key decision-making. But that's very fact-specific.
Okay. And what about routine, day-to-day operational stuff, like repairs, quality checks?
Those decisions made by junior or middle management are generally not relevant for POM. They're different from the key strategic management and commercial decisions. You need to distinguish, especially if the same person happens to make both types of decisions.
So if after looking at all these primary factors, delegation, committees, head office, residency of decision makers, the POM is still unclear, are there secondary factors?
Yes, if it's still ambiguous, you might look at secondary factors, like the place where the main and substantial activity of the company is actually carried out, or the place where the primary accounting records are kept.
And it's important to look at the whole picture over time, right? Not just one single fact.
Absolutely vital. POM determination is based on all relevant facts and circumstances over a period of time, not just isolated facts at one specific moment. And just having local management in India or support functions that are merely preparatory or auxiliary, that's not by itself conclusive proof that POM is in India. These are guiding principles. No single one is automatically decisive.
Okay, let's walk through that detailed example of applying the POM rules using Singtel Ltd. It's a Singapore company, 55% owned by an Indian co, with operations in both India and Singapore. We need to figure out its residency for AY 2025-26 using the ABOI test first.
Right. Let's meticulously apply the 4 ABOI conditions using the provided data.
Condition 1. Passive income 50% of total income. First, total income India. 45 crores, 25 trading less 20 interest dividend. Singapore, 65 crores, 50 trading plus 15 interest dividend. Grand total income plus 45 plus 65 equal 110 crores.
Okay, now passive income. Income from transactions where both purchase and sale are from Verto-associated enterprises. India free 50 plus Singapore euro 10 euro 15 crores. Income from interest and dividend. India 20 CR plus Singapore equals 15 CR or 35 crores. Total passive income equals 15 plus 35 equals 50 crores.
So the percentage is 50 crores, 110 crores, 100 equals 45.45%. That's less than or equal to 50%. Condition 1 is satisfied.
Good. Condition 2. Indian assets 50% of total assets. Let's sum the assets. India, fixed 120 euro plus intangible 50 euro plus other euro 50 euro plus other euro 40 euro 210 euro plus Singapore. Fixed euro and 80 euro plus other euro 210 crores, other euro 20 euro 8 euro crores. Grand total assets almost 2010 plus 400 euro 610 crores.
Okay. Percentage of Indian assets is 210 crores and 610 crores. 100 equals 34.43%. That's less than 50%. Condition 2 is satisfied.
Excellent. Condition 3. Indian employees, 50% of total employees. Employees in India, 70. Employees in Singapore, 90. Total employees equals 70 plus 90 equals 160.
Percentage of Indian employees is 17 on 60, 100 equals 43.75%, less than 50%. Condition 3 is satisfied.
Almost there. Condition 4. Indian payroll, 50% of total payroll. Payroll in India, 8 crores. Payroll in Singapore, 12 crores. Total payroll is 8 plus 12 equals 20 crores.
Percentage of Indian payroll is 8 crores over 20 crores, 100 decreases 40%, less than 50%. Condition 4 is satisfied.
Perfect. Since all 4 ABUI conditions are satisfied, Singtel Ltd is definitively engaged in active business outside India.
Right. So for such a company, the next step for POM is looking at where the board meetings were held. The data says 8 total meetings, 3 in India, 5 in Singapore.
And since the majority of board meetings, 5 out of 8 were held outside India, Singtel Ltd's POM is presumed to be outside India.
Therefore, based on this whole analysis, Singtel Ltd is considered a non-resident for AY 2025-26. That really shows how the detailed conditions work together.
It does. And remember that important threshold. These POM guidelines do not apply at all to a company if its turnover or gross receipts are 50 crores or less in a financial year. That's a key de minimis rule.
Okay, that was an incredibly detailed journey through residency and POM. Now that we understand who is resident, let's tackle the what. What kind of income India actually taxes? This brings us to the scope of total income under Section 5, and then the really crucial Section 9 covering income deemed to accrue or arise in India.
Yes. Section 5 is foundational. It states that the scope of an SSE's total income depends entirely, directly on their residential status. Let's break it down.
Okay. First, for a resident, an ordinarily resident, an RR.
For an RRR, they are taxable on their global income. Everything.
Global income, wow.
Yes. This means income received or deemed received in India no matter where earned. Income accruing or arising or deemed to accrue or arise in India no matter where received. And income accruing or arising outside India and received outside India. Worldwide income is in the net for RRs.
Okay. But if you're a resident but not ordinarily resident, an R&R, the net is smaller.
Significantly narrower, yes. An R&R is taxable on income received or deemed received in India, and income accruing or arising or deemed to accrue or arise in India. Same as an RR so far.
What?
But crucially, they are also taxable on income derived from a business controlled from India or a profession set up in India, even if that income accrues and is received entirely outside India.
Ah, the control from India or set up in India connection pulls that foreign income in for R&Rs.
Exactly. The key distinction is that all other foreign income accruing outside India, received outside India, and not from a business controlled from profession set up in India is not included in their total income.
Right. And finally, for a non-resident, an NR, the most restricted scope.
The most restricted, yes. An NR is taxable only on income received or deemed to be received in India, and income accruing or arising or deemed to accrue or arise in India. That's it.
So no foreign income is taxed unless it's specifically deemed to accrue here under Section 9 or received here.
Correct. No income accruing and arising outside India, unless deemed and received outside India is taxable for an NR. This classification, RRR, RNR, NR, is absolutely central.
Now, there was an important clarification for seafarers, wasn't there, regarding salary credited to Indian bank accounts?
Yes, a crucial one from the CBDT via circulars. Historically, sometimes non-resident seafarers earning salary for services rendered entirely outside India on foreign ships were taxed just because the salary was credited to their NRE bank account in India.
Right, seem unfair.
It did. So the CBDT clarified that such salary income shall not be included in total income merely because it's credited to an NRE account in India.
Why the clarification?
Because the income itself for services rendered outside India doesn't accrue or arise in India under Section 5.2. The place of receipt into an NRE account doesn't change the place of accrual for services performed abroad.
That makes sense. Insurers using an Indian bank doesn't automatically trigger tax when the work is foreign.
Exactly. Now, we transition to Section 9, income deemed to accrue or arise in India. This is a really powerful section
Why powerful?
because it specifies certain types of income that are treated as accruing or arising in India, even if they actually physically accrue or arise outside India. It's India's legal way to tax non-residents on income streams connected to India.
Okay, what's the first category under Section 9.1? Looks like Clause I is quite broad.
It is. Clause I covers income, accruing or arising, directly or indirectly, through or from several sources.
Mhm.
Any business connection in India, any property, asset, or source of income in India, or the transfer of a capital asset situated in India.
Let's unpack business connection. That sounds like it could cover a lot.
It's very expansive. Explanation 2 to Section 9 clarifies it. It includes business activity done through someone acting on behalf of the non-resident if that person does certain things habitually in India,
Like what?
like habitually exercising authority to conclude contracts for the non-resident, or playing the principal role leading to contracts being concluded, contracts in the non-resident's name, for transferring property they own or control, or for providing services.
Okay, concluding contracts. What else?
Also, habitually maintaining a stock of goods in India from which they regularly deliver on behalf of the non-resident, or habitually securing orders in India mainly or wholly for that non-resident.
So, acting like an agent who gets orders or holds stock.
Right, and it even extends further. A business connection is also established if a person secures orders mainly or wholly for other non-residents who control, are controlled by, or are under common control with the first non-resident. Cage's group structures.
Wow, okay. But surely there's an exception for, like, independent agents.
Yes, a vital carve-out. A business connection is not established if the non-resident just carries on business through a genuine broker, a general commission agent, or any other agent who truly has an independent status. Provided that independent agent is acting in the ordinary course of their business and does not work mainly or wholly for that specific non-resident or connected non-residents, protects genuine arm's-length agency relationships.
That makes sense. Now, a more modern addition here is significant economic presence, or SEP's explanation 2A.
Yes, SE. This was introduced specifically to capture and tax activities in the digital economy where physical presence might be minimal.
Okay. How does SE create a business connection?
It constitutes a business connection if it results from either of two things. First, a transaction threshold.
The threshold based on.
Any transaction for goods, services, or property. And this explicitly includes downloading data or software carried out by a non-resident with any person in India, where the aggregate payments from such transactions exceed 2 crores during the previous year.
2 crores in payments from India for goods, services, data.
Okay.
What's the alternative?
The alternative is a user threshold. This is triggered by systematic and continuous soliciting of business activities or engaging in interaction with users in India, where the number of such users is at least 3 lakhs.
3 lakh users in India.
Okay, and what's really crucial here is that these transactions or user interactions constitute SE whether or not any agreement is physically signed in India, whether the non-resident has any residence or place of business here, or even whether services are technically rendered in India.
Location is irrelevant if the thresholds are met. And how much income is taxed then? All of it.
No, importantly, where SIP creates a business connection, only the income that is reasonably attributable to those specific SEP transactions or activities is deemed to accrue or arise in India.
So it's targeted, like income from ads targeting Indian customers or selling data collected from people in India.
Exactly. Income from ads targeting Indian customers or IP addresses, income from selling data collected from persons in India or using Indian IP addresses, income from selling goods services using data collected from persons in India, Those are examples of attributable income.
Now, what if a business has operations both inside and outside India, but it's not based on SEP? How is the income split?
For those general business operations not wholly carried out in India, covered by Explanation 1A, only the part of the income that is reasonably attributable to the operations carried out in India is deemed to accrue or arise here.
So you apportion the profits. The part not attributable to Indian operations isn't taxed here.
Correct, that income is not taxed in India.
Okay, the other big part of clause was transfer of a capital asset situated in India. How does that work, especially if the asset is, say, shares in a foreign company?
This is where Explanation 5 comes in. It's another powerful deeming provision. An asset or capital asset, and this explicitly includes shares or an interest in a company or entity incorporated outside India,
Right.
is deemed to be situated in India if its value is substantially derived, directly or indirectly, from assets located in India.
Substantially derived, what's the threshold for that?
The value derived is considered substantial if it meets two conditions. It must exceed A2 crore AND. It must represent at least 50% of the value of all assets owned by that foreign company or entity.
10 crore and 50% of total assets. How is value determined?
Fair market value on the specified date, importantly, without reduction of liabilities.
And the specified date, usually the balance sheet date.
Usually the latest balance sheet date before the transfer date. However, there's a key exception. The date of transfer itself becomes the specified date if the book value of assets on the transfer date has shot up, specifically if it exceeds by at least 15% the book value on the last balance sheet date. Catches situations where asset values change rapidly near transfer time.
Okay. And the accounting period for checking this value?
Usually 12 months ending March 31, but it can be another 12-month period if the foreign company regularly uses that for tax or reporting in its home country.
Are there any exclusions from this deeming rule? Situations where foreign shares deriving value from India are not deemed situated here?
Yes, there are important exclusions. It specifically does not apply to investments made by a non-resident, directly or indirectly, inserted readily. Foreign portfolio investors, specifically Category 1 or Category 2 FPIs under the old SEBI regs, or Category F FPIs under the 2019 regs. Shares or interests in these FPIs are not deemed situated in India by this rule.
Okay, FPIs are out. Anything else?
Also, income from redemption or buyback of shares interests held indirectly in specified funds like investment funds, VCCs, VCFs is excluded,
Under what conditions?
provided that income accrues from the transfer of Indian shares or securities by the fund itself, that income is taxable in India, and the redemption proceeds the non-resident gets don't exceed their pro rata share of what the fund realized from selling the underlying Indian assets. Direct investors in these specified funds are taxed normally, though.
Got it. And is there any relief for small investors caught by this indirect transfer rule? Seems complex.
Yes, there's an exemption specifically for small investors. A non-resident transferring shares interest in a foreign entity is exempt if they, alone or with associated enterprises, at no time in the 12 months before the transfer held other management or control rights in that foreign entity.
Okay, no management or control.
Or held voting power, share capital, or interest exceeding 5% of the total.
5% threshold. Does this apply even if the foreign company only indirectly owns the Indian assets?
Yes, the exemption extends there too, provided the transfer doesn't hold management control in the foreign company, or any right entitling them to management control, or more than 5% voting share capital in the company that directly holds the Indian assets. It aims to shield passive, small investors.
That makes sense. And what if the foreign company holds assets both inside and outside India? Is the whole gain taxed?
No, it's proportionate. If not all assets of the foreign company entity are in India, then only the part of the income reasonably attributable to the assets located in India is deemed to accrue or arise here. Ensures proportionate taxation.
Okay, that covers the complex clause. What's next in Section 9.1? Clause 3 seems specific to government employees.
Yes, Clause 3 states that any salary payable by the government to an Indian citizen for services rendered outside India is specifically deemed to accrue or arise in India. So, taxable here.
But isn't there an exemption often related to this?
Immediately following this rule is a key exemption under Section 10.7. Allowances and perquisites paid or allowed outside India by the government to an Indian citizen for those services rendered outside India are entirely exempt from tax. And this applies regardless of the tax regime the individual chooses.
Let's take an example. Jay is an Indian citizen, works at the Indian embassy in Tokyo, gets salary and allowances from the Indian government, and is non-resident for the year.
Right. In that case, Jay's salary is taxable in India because of Section 9. 3. However, all the allowances and perquisites received for the services in Tokyo are completely exempt under Section 10.7. A very clear distinction.
Got it. Clause 4 looks straightforward. Dividend from an Indian company.
Yes, Clause 4 is simple. Any dividend paid by an Indian company, even if paid outside India, is deemed to accrue or arise in India. Therefore, taxable here for non-resident shareholders.
Okay. Clause 5 covers interest. When is interest deemed to accrue in India?
Interest is deemed to accrue or arise in India if it's payable by the government or by a person who is a resident in India.
But there's an exception based on usage, right?
Yes, a crucial one.
Yeah.
If the money borrowed was used for the purpose of a business or profession carried on outside India, or for earning income from any source outside India, then the interest paid on that borrowing is not deemed to accrue or arise in India. The end use of the funds is key.
Okay. And there's a special rule for banks.
Yes, for permanent establishments,
Yeah.
PEs, of non-resident banking businesses, interest payable by an Indian PE of a non-resident bank to its own head office or any other PE or part of that bank located outside India. That interest is deemed to accrue or arise in India.
Closes a potential loophole for internal bank funding of Indian operations.
Precisely. Ensures those internal interest payments related to Indian banking operations are taxed here.
Next up, clause binding deals with royalty. Similar structure.
Very similar structure to interest. Royalty is deemed to accrue or arise in India if payable by the government or by a person who is a resident.
And the same utilization exception.
Yes. If the royalty-generating right, information, or equipment is utilized for a business profession carried on outside India, or for earning income from a source outside India, then the royalty is not deemed to accrue in India.
What if the payer is a non-resident? Can royalty still be deemed to accrue here?
Yes. Royalty is also deemed to accrue if payable by a non-resident, but only if the underlying right, information, or equipment is utilized for a business or profession carried on by that non-resident in India, or for earning income from any source in India. Again, utilization in India is the trigger.
Okay. And the definition of royalty itself, it seems quite broad in the Act.
It is very broad. It includes consideration, lump sum, or periodic, but not capital gains for several things. Transferring rights, including licenses, in patents, inventions, designs, secret formulas, trademarks, etc. Imparting info on using such properties, just the use of such properties.
Also knowledge and skills?
Yes, also imparting information concerning technical, industrial, commercial, or scientific knowledge, experience, or skill. And finally, the use or right to use any industrial, commercial, or scientific equipment, but excluding amounts covered by Section 44BB for mineral oils.
And computer software? That's a big one.
A very significant clarification came via Explanation 4. Consideration for the use or right to use computer software, including granting a license, is deemed royalty, regardless of how it's delivered. CD, download, etc. This generally means TDS under 194J or 195 would apply.
But didn't a major Supreme Court ruling clarify this, especially regarding tax treaties, the engineering analysis case?
Yes, a landmark ruling in 2021. The issue was that the Income Tax Act's definition of royalty, with Explanation 4, is wider than the definition in many DTAs, which often don't explicitly include payments for the use or right to use software itself, only for the underlying copyright.
So what did the Supreme Court find?
The court looked at 4 common scenarios. End users buying directly from foreign suppliers, Indian distributors buying and reselling, foreign vendors reselling to Indian distributors send users, and software bundled with hardware.
And in those cases?
In those specific cases, the court found that the distribution agreements and EOLAs typically did not transfer any right that amounted to using the copyright of the software. They only granted a license to use the copyrighted product.
So the payment wasn't for the copyright itself.
Exactly. Therefore, the Supreme Court concluded that in these specified scenarios, the amount paid by Indian end users or distributors to non-resident software maker suppliers is not royalty under the more restrictive definitions found in the DTAAs.
Meaning?
Meaning it's not chargeable to tax in India under the treaty, and consequently, no TDS is required under Section 195. This ruling emphasizes that the DTAA definition prevails if it's more beneficial than domestic law. Huge implications for the software industry.
Absolutely. And one last point on royalty, Explanation 6 clarifies process.
Yes. Explanation 6 confirms that process, in the royalty definition, includes, and always has included, transmission by satellite, cable, optic fiber, or similar tech, whether the process is secret or not. Captures modern transmission methods.
Okay. Clause 7 covers fees for technical services, or FTS. Does it follow the same pattern as interest and royalty?
It does, very closely. FTS is deemed to accrue or arise in India if payable by the government or by a person resident in India.
With the same utilization exception.
Yes. If the FTS is for services utilized in a business or profession carried on by the resident outside India, or for earning income from a source outside India, then it's not deemed to accrue in India.
And if the payer is a non-resident?
Also deemed to accrue if payable by a non-resident, but only if the FTS relates to services utilized in a business or profession carried on by that non-resident in India, or for earning income from any source in India. Utilization in India is key.
And there's a clarification below Section 9.2 that reinforces this.
Yes, a very important one. The explanation below Section 9.2 makes it crystal clear that income from FTS, interest, or royalty deemed to accrue under 9.5, 6, or 7 will be included in the non-resident's total income, whether or not the non-resident has a residence, place of business, or business connection in India, and whether or not the services were physically rendered in India.
It really hammers home that the place of utilization is the deciding factor for these deemed accruals.
Absolutely. The physical location of the service provider or the place of payment becomes secondary.
Let's use that example again. Miss Vivita, resident, pays 5,000 USD to Mr. Kulisakura, and our consultant in Colombo, for advice on financing an Indian project, payment in Colombo.
Right. The payment is for project financing consultancy, clearly FTS, managerial consultancy. The crucial point is, where were the services utilized?
For an Indian project, so utilized in India.
Exactly. Therefore, even though Mr. Kulasakar is NR and paid in Colombo, the income is deemed to accrue or arise in India under Section 9, reread with that explanation below 9.2, because of the utilization in India. It's chargeable to tax here. Classic exam question setup.
Definitely. Finally, clause of Section 9.1. This one deals with sums of money paid without consideration. Gifts, essentially.
Yes, specifically gifts of money originating outside India. If income arises outside India, being a sum of money paid without consideration by an Indian resident to a non-corporate non-resident, or a foreign company, or even an R&R,
Then,
it's deemed to accrue or arise in India if that sum would be chargeable as income under Section 562, the general gift taxation provision.
is there a threshold?
Yes, this deeming provision applies only if the aggregate of such sums received by the non-resident from that resident exceeds $50,000 in the previous year.
And importantly, this applies only to sums of money, not property transfers outside India.
Correct. This deeming rule is limited to sums of money transferred without consideration. It doesn't cover gifts of movable or immovable property made outside India.
Phew! That concludes our deep dive into the scope of total income and deemed accrual. It's clear India has a pretty comprehensive framework for taxing income connected to it, even if it originates elsewhere. Now, let's shift gears to something potentially simpler: presumptive taxation.
Yes, these provisions are designed to simplify compliance for certain non-resident businesses. Instead of calculating actual profits from detailed accounts, a fixed percentage of gross receipts is just presumed to be the taxable profit.
Okay, let's start with the shipping business under Section 44B. This doesn't apply to cruise ships, right?
Correct. Section 44B is for regular shipping operations, not cruise ships. They have 44B BC. It starts with a non-obstant clause, meaning it overrides the normal profit computation sections, 28 to 43A.
So no deductions for normal expenses.
Yeah. Generally, no. Normal deductions are not allowed when using this section. It applies specifically to non-residents engaged in the business of operating ships, excluding cruise ships.
And the presumptive income rate?
It's a sum equal to 7.5% of the aggregate of two key amounts. First, amounts paid or payable, in or out of India, to the non-resident for carriage of passengers, livestock, mail, or goods shipped at any Indian port.
Okay, freight loaded in India.
Second, amounts received or deemed received in India by the non-resident for carriage of passengers, livestock, mail, or goods shipped at any port outside India.
So freight loaded outside, but payment received in India. Does this include things like demurrage?
Yes, the law explicitly includes demurrage charges, handling charges, or any other similar charges in these amounts.
And while normal deductions aren't allowed, you mentioned something about losses?
Yes, a crucial point for exams. Carried forward losses are allowed to be set off against this deemed income calculated at 7.5%.
Okay. Now, how does this Section 44B relate to Section 172, which also deals with shipping?
Good question. They serve different purposes. Section 44B just gives the presumptive tax rate for non-residents in the shipping business generally. It doesn't have assessment or collection procedures within it.
Whereas Section 172.
Section 172 is a complete code specifically for taxing the occasional shipping business of non-residents. It covers everything: assessment, collection, the whole process for specific voyages.
And it has specific obligations, like the shipmaster filing a return.
Yes, under 172, for an occasional voyage, the master must file a return before the ship leaves an Indian port, showing the full amount paid payable for carriage from that port since the last arrival. Or an agent can file within 30 days if the AO agrees.
And then a quick assessment happens.
A summary assessment under 172. The AO taxes 7.5% of the carriage amount at foreign company rates, and the master is liable. And crucially, under 172.6, the customs collector won't grant port clearance until this tax is paid or arrangements are made. It has teeth.
Right. Let's use that seaport shipping line example. Non-resident company, goods from Mumbai. Freight 100 lakhs, demurrage is 20 lakhs, handling 10 lakhs, total receipts 130 lakhs, actual expenses were 110 lakhs.
Okay, Section 44B applies. Total specified receipts equal 100 plus 20 plus 10 equals 130 lakhs. The actual expenses of 110 lakhs, irrelevant for 44B.
So the deemed profit is?
7.5% of 130 lakhs
Yeah.
equals 9.75 lakhs. That's the taxable income under 44B. Any tax already paid under the Section 172 procedure for that voyage would, of course, reduce the final tax payable on this income.
Okay. Moving on to exploration of mineral oils, Section 44BB, also presumptive.
Yes. Section 44BB also has a non-obstanta clause, overriding Sections 28 to 41, 43, and 43A. It applies to non-residents providing services, facilities, or supplying plant machinery on hire for prospecting, extraction, or production of mineral oils.
And the rate here?
The presumptive income rate is 10% of the aggregate of amounts paid payable in or out of India for providing these services facilities in India, and amounts received in India for providing these services facilities outside India.
Are there situations where 44BB doesn't apply even if it seems relevant?
Yes, importantly, 44BB does not apply if the income is already specifically covered by other sections, like Section 42, special provisions for mineral oils, 4040A, royalties FTS connected to PE, 115A, gross basis taxation, or 293A.
Can the taxpayer declare lower profits than 10% here?
Yes. Similar to some other presumptive sections, the assessee may claim lower income than the 10% rate, but only if they maintain proper books of account under 44AA2 and get them audited and furnish the audit report under 44AB. If they do that, the AO assesses them normally under Section 143 based on actual profits.
Okay, option to opt out with proper books and audit. Now for aircraft operations, Section 44BBA.
Right. Again, override Sections 28 to 43A. Applies to non-residents operating aircraft.
And the rate is lower here.
Yes, the presumptive rate is 5% of the aggregate of two amounts. Amounts paid payable in or out of India for carriage of passengers, livestock, mail, or goods from any place in India.
Okay, uplifted from India. And the second amount?
Amounts received or deemed received in India for carriage of passengers, livestock, mail, or goods from any place outside India.
Let's use that example of Mr. Q operating between Singapore and Chennai.
Okay. Received 2 CR in India for carriage from Chennai, received 1 CR in India for goods from Chennai, received 3 CR in India for passengers from Singapore, received 1 CR in Singapore for passengers from Chennai.
Right, so the total specified sum under 44BBA needs careful calculation.
Let's break it down. First, amounts from India, paid payable anywhere. That includes the 2 CR, passengers ex Chennai, received India, the 1 CR, goods ex Chennai, receives India, and the 1 CR, passengers ex Chennai, received Singapore. So that's 2 plus 1 plus 1 receives 4 CR.
Got it. All carriage from Chennai included. Now, amounts from outside India, but received in India.
That's the already 3 CR received in India for passengers from Singapore.
So the aggregate is 4 CR plus 3 CR plus 3 CR, 7 CR.
Correct. And the deemed profit is 5% of 7 euro, 35 lakhs. That's the taxable income. And remember, 44BBA applies equally to non-resident individuals like Mr. Q or non-resident companies operating aircraft.
Okay. There's also Section 44BBB for civil construction in turnkey power projects.
Yes, a very specific one. Applies only to foreign companies engaged in civil construction, erection, testing, or commissioning of plant machinery, specifically in connection with a turnkey power project that has been approved by the central government.
And the rate.
The presumptive rate is 10% of the amount paid or payable in or out of India for that specific work.
Can they claim lower profits here too?
Yes, similar to 44BB, they can opt for normal assessment by maintaining books and getting an audit. However, a key restriction applies if they stick with the 10% rate under 44 BBB.
What's the restriction?
If they declare profits at the 10% presumptive rate, then no set-off of unabsorbed depreciation and brought forward loss is allowed for that previous year. That's significant.
Definitely. Okay, now for cruise ships, Section 44 BBC.
Right. This applies to non-residents operating cruise ships, subject to certain conditions. The presumptive rate is higher here.
How high?
Profits are deemed to be 20% of the aggregate of amounts paid or payable for carriage of passengers, and amounts received or deemed received for carriage of passengers.
And there was a related exemption for lease rentals.
Yes, under Section 1015B. If a foreign company pays lease rentals for a cruise ship to another foreign company, and the paying company opts for this 44 BBC presumptive regime, those lease rentals can be exempt in the hands of the recipient foreign company.
What's the condition?
Both foreign companies must be subsidiaries of the same holding company. This exemption is available up to assessment year 2030-31.
Okay, that covers the main presumptive sections. Now, what about head office expenses for non-residents with branches or PEs in India? Section 44C.
Yes, Section 44C is critical for those scenarios. It also starts with a non-obstant clause, overriding normal deduction rules, 28 to 43A, specifically for head office expenses.
And it restricts the deduction.
Significantly. For a non-resident, the deduction allowed for head office expenditure is restricted to the least of two specific amounts.
Amount what?
An amount equal to 5% of adjusted total income, or 5% of average adjusted total income if adjusted total income is a loss.
Amount two.
The actual amount of head office expenditure incurred by the SSE that is genuinely attributable to their business or profession in India.
So the lower of 5% of adjusted income or actual attributable expense is the max deduction. What exactly is adjusted total income?
It's the total income calculated before deducting several specific items. The head office expenditure itself, unabsorbed depreciation, capital expenditure on family planning, various carried forward losses, business, speculative capital, racehorse, and Chapter 6A deductions.
And average adjusted total income is just an average over the last few years.
Yes, based on the assessable total income for the 3 immediately preceding assessment years, using 1312 or full amount depending on how many years are available.
And head office expenditure itself means what?
It means executive and general administration expenses incurred by the SSE outside India. Things like rent, rates, taxes, repairs for premises outside India used for the business, salaries, wages, perks for employees managing offices outside India, their travel expenses, and other prescribed admin expenses.
Let's use that example. Branch of a foreign company has a net loss of 100 lakhs after charging 200 lakhs in head office expenses.
Okay, first step, calculate adjusted total income. Net loss, 90 euro lakhs, plus head office expenses added back, plus 200 lakhs or 100 lakhs adjusted total income.
Now, apply the 44C restriction. Allowable HO expenses are the lower of.
Lower of. 1.5% of adjusted total income equal 5% of 100 lakhs equals 5 lakhs. 2. Actual attributable HO expenses equals 200 lakhs.
So the allowed deduction is just 5 lakhs.
Correct. Only 5 lakhs is allowed.
Therefore, the income the branch must declare is
Adjusted total income 100 lakhs, allowable HO expenses 5 lakhs or 95 lakhs. Shows how dramatically 44C can limit the deduction, turning a reported loss into a significant taxable income.
definitely a key point. Now, another special provision. Section 44DA. Computing income from royalties, FTS, etc. in specific cases.
Yeah, 44DA applies in a very specific situation involving royalty or FTS. The income must arise from an agreement made by a non-resident with an Indian company or the government after March 31st, 2003.
Okay.
And the non-resident must carry on business profession in India through a permanent establishment, PE, or fixed place of profession, FPP.
Right.
And the specific right, property, or contract generating the royalty FTS must be effectively connected with that PE or FPP in India.
So, royalty FTS linked directly to an Indian PE FTP. How is it taxed then, not under the special rates?
Correct. In this specific case, the income is not taxed as pure royalty FTS. Instead, it's computed under the head profits and gains of business or profession, PGBP. Normal tax rates apply.
Which means?
Which means the non-resident must maintain books of account, Section 44AA, and get them audited, furnish the report, Section 44AB, 1 month before the tax return due date.
Are there specific disallowed expenses under 44DA?
Yes. Any expenditure or allowance, not wholly and exclusively for that PEFPP in India, is disallowed. Also, any amounts paid, other than reimbursement of actual costs, by the PEFPP to its head office or other offices outside India are disallowed.
In Chapter 6A, deductions.
Not permissible for income computed under 44DA.
Okay. Section 44DA also had that special rule for computing capital gains on shares bought in foreign currency, overriding the normal Section 48 proviso.
Yes, a special method for capital gains on transfer of shares or debentures in an Indian company purchased by a non-resident in foreign currency.
How does it work?
You take the cost of acquisition and the sale consideration, and you first convert both into the foreign currency that was originally used for the purchase.
Okay, convert to original currency first.
Then you compute the capital gain in that foreign currency.
Calculate gain in foreign currency. Finally.
Then you reconvert the resulting capital gain back into Indian currency using the telegraphic transfer buying rate on the date of transfer.
And critically, no indexation benefit here.
No indexation benefit is available for these specific capital gains. This applies regardless of when the transfer happened. Rule 115A gives the precise exchange rates.
But this special currency fluctuation method doesn't apply to everything, like Section 112A shares.
Correct. It's not available for long-term capital assets covered by Section 112A, like listed equity shares where STT is paid.
Let's use that example from the source to nail this down. NRI bought unlisted Indian shares for $1,020,000 in foreign currency, sold for $4,080,000. Assume acquisition rate 1 USD equals 20 INR, sale rate 1 USD equals 60 INR, and reconversion rate 1 USD equals 59 INR.
Okay. Step 1, convert to USD. Sale consideration. $4,080,000, $60,000 cost of acquisition, no $1,020,000 $6.
Step 2, calculate gain in USD.
LTCG in USD equals $8,000. Sale, $6,000. Cost $2,000.
Step 3, reconvert gain to INR.
LTCG in INR equal $2,000, 59 reconversion rate. INR $1,018,000. That's the taxable LTCG, calculated using this specific method, accounting for currency changes but without indexation.
Very specific, very important. Okay, we've covered a massive amount on fundamentals. Let's now explore income streams that are exempt for non-residents, taxed under special rates, or subject to specific withholding tax rules, and maybe touch on some admin provisions.
Sounds good. First, let's highlight some key exempted income for non-residents under Section 10. There's Section 10(4)(c), exempting interest on certain offshore rupee-denominated bonds, but only those issued between Sep 17, 2018 and Mar 31st, 2019. Payable by an Indian company or business trust to non-corporate NRs or foreign companies.
Okay, specific bonds, specific period. Then Section 10(4)(d) for specified funds.
Yes. 10(4)(d) exempts income of a specified fund from transferring certain assets like securities, but not shares in Indian companies, or securities issued by a non-resident if income doesn't otherwise accrue in India, or income from a securitization trust.
But the exemption is limited.
Limited to the extent the income is attributable to units held by non-residents, not Indian PEs, or the investment division of an offshore banking unit.
And there's a compliance requirement.
Yes, the fund must file an annual statement of its exempt income and an audit report for investment divisions by the return filing due date. The definitions of securities, investment division of offshore banking unit in an IFSC started by March 31st, 2025, and specified fund itself are very precise, involving AF/TF registration, IFSC location, non-resident, unit-holding rules, etc.
Okay. Section 10(4)(e) exempts income from
non-deliverable forward contracts, offshore derivatives, or OTC derivatives, if entered into by a non-resident with an offshore banking unit in an IFSC.
And 10(4)(f) for aircraft ship leases.
Exempts royalty or interest received by a non-resident for leasing an aircraft or ship if paid by an IFSC unit under ADLA 1A, started by March 31st, 2025.
Section 10(4)(g) covers income in accounts with offshore banking units.
Yes, exempts income received by a non-resident from a portfolio of securities funds managed by a portfolio manager or other notified activity, in account with an offshore banking unit in an IFSC, to the extent that income accrues or arises outside India and isn't deemed to accrue here.
Section 10(4)(h), capital gains on transferring shares of IFSC units involved in aircraft leasing.
Right. Exempts capital gains for a non-resident or an IFSC unit aircraft leasing started by March 31st, 2026, when they transfer equity shares of a domestic company, which must also be an IFSC unit primarily in aircraft leasing. This exemption runs for 10 assessment years.
Okay. Section 10(6) has exemptions for individuals who aren't Indian citizens, like foreign diplomats.
Yes, 10(6) exempts remuneration of foreign diplomatic officials and their staff, if not citizens, and no other Indian business employment.
And 10(6) for employees of foreign enterprises, the 90-day rule.
That's the one. Remuneration of a non-citizen employee is exempt if A, their foreign employer isn't engaged in Indian business. B, their stay here doesn't exceed 90 days in the previous year.
Uh,
And C, their pay isn't deducted when calculating the foreign employer's taxable income in India. All three must be met. Crucial points, those.
and 10.6 for foreign ship crew.
Exempts the salary of a non-citizen, non-resident crew member on a foreign ship if their total stay in India doesn't exceed 90 days in the previous year.
Okay. Section 1015B, lease rentals of cruise ships again.
Exempts income of a foreign company from lease rentals of cruise ships received from a specified company operating them in India, provided both are subsidiaries of the same holding company. Available up to AY 2030-31.
Section 1023FE, LTCG for sovereign wealth funds, pension funds.
Exempts their LTCG from investments in India, debt shares units, if the investment was made between April 1st, 2020 and March 31st, 2025, and held for at least 3 years.
Eligible investments include infrastructure.
Yes, includes business trusts, companies developing, maintaining infra, Cat 3 AIFs with 50% in ineligible costs, certain domestic companies set up after April 1, 2021, 75% in infra, NBFCs registered as IFCIDF, 90% lending to infra. If the investment vehicle itself has less than 100% in eligible entities, the exemption is proportional.
And the key condition about loans.
The exemption is not available if the fund took loans or borrowings specifically to make the investment in India. The CBDT clarified that general borrowings are okay if not earmarked for India, and the Indian investment isn't sourced from them.
Okay, 2 more quick exemptions. 1034B for dividends.
Exempts dividends received from a company that's an IFSC unit, primarily leasing aircraft.
And 1048 for selling crude oil or notified goods services.
Exempts income received in India, in INR, by a foreign company from selling crude oil or other notified goods services to someone in India if the agreement is notified by the central government in the national interest.
That's a lot of specific exemptions. Now let's shift to special computation provisions, starting with Chapter 12A for non-resident Indians, NRIs.
Right. Chapter 12A provides special treatment for NRI investment income and long-term capital gains from specific assets. Section 115C defines key terms.
Like convertible foreign exchange.
That's foreign exchange treated as such by the RBI. An NRI is an individual, Indian citizen, or PIO who is not a resident. And specified asset includes things like shares in Indian companies, certain debentures deposits, central government securities, etc., bought with foreign exchange.
And how is the income taxed under 115D?
Strictly on a gross basis, no deduction for any expenditure or allowance when computing investment income or LTCG from these specified foreign exchange assets.
What about Chapter 6A deductions?
If the NRI's only income is this investment income LTCG, no Chapter ZA deduction. If they have other income too, VIA is allowed only against that other income. And importantly, no indexation benefit for these capital gains.
What are the tax rates under 115E?
Investment income is taxed at a flat 20%, plus surcharge plus HEC. Long-term capital gains from transferring these specified assets, bought in foreign currency, depend on the transfer date. 10% plus surcharge plus HEC for transfers before July 23, 2024, and 12.5% plus surcharge plus HEC for transfers on or after July 23, 2024. Any other income is taxed at normal rates.
Is there an exemption for these LTCG if reinvested, Section 115F?
Yes, a significant one. If an NRI has LTCG from transferring a foreign exchange asset and reinvests the whole or part of the net consideration into any specified asset within 6 months of the transfer.
Then,
If the cost of the new asset is net consideration, the whole LTCG is exempt. If the cost is less, a proportionate exemption applies. LTCG, cost of new asset net consideration.
net consideration being sale price minus transfer costs, and there's a lock-in period for the new asset.
Yes, a crucial recapture rule. If the new asset acquired for the exemption is transferred or converted into money within 3 years of its acquisition, the previously exempted LTCG becomes taxable as capital gains in the year the new asset is sold converted.
Let's quickly rerun that example for 115F. NRI buys shares in 2009 for €1 foreign currency, sells Jan 2025 for 3L, reinvests 3L in shares Mar 2025, sells new shares June 2025 for 3.5F.
Yeah, 2025-26. LCCG on original shares equal 3L 1L euro 2L, exemption is 115F. Reinvestment 3L equals net consideration 3L. So entire 2L LTCG is exempt for AY 2025-26.
But then, AY 2026-27.
Recapture. The new shares sold within 3 years. So the euro LTCG, previously exempt, becomes taxable in AY 2026-27. Plus, there's SECG on the new shares. 3.5L sale, 3L cost worth $14,000. That's also taxable. Shows the importance of the 3-year hold.
Very clear. Now, moving beyond just NRIs, Chapter 12 has broader special tax provisions. Section 115A for royalty, FTS, interest, dividend for NR foreign coasts.
Yes, 115A provides special, usually concessional tax rates for these incomes when they aren't linked to a PE, where 44DA might apply.
What are some key rates under 415A? Dividends from IFSC units.
10%. Other dividends, 20%. Interest from GovTindian concern on foreign currency loans, 20%. But interest on foreign currency loans borrowed between July 2012 June 2023, only 5%. Interest on certain rupee-denominated bonds issued after July 4, 2023, listed on IFSC, 5%. Distributed interest from business trust via SPV, 5%. Income from MFUTI units, foreign currency purchased, 20%.
And royalty FTS rates if 44DA doesn't apply.
Generally 20% if from GovTindian concern under an approved agreement aligning with industrial policy. But critically, if a DTAA provides a lower rate, the DTAA rate applies.
And generally, no deductions allowed against these incomes taxed under 115A.
Correct. Generally, no deductions under sections 28, 44C, or 57. No Chapter VSA deduction either, except ADLA for IFSC unit dividend interest. It's taxation on a gross basis.
And just to recap the flowchart, royalty FTS effectively connected to an Indian PEFPP section 4040A, PGBP, normal rates, books out it. Royalty FTS not effectively connected section 115A, gross basis 20% or DTAA rate, no deductions.
Perfect summary.
Okay, section 115AB, income from units of offshore funds.
Applies to income from units purchased in foreign currency or LTCG from transferring such units. Income from units, 10% LTCG, 10% transfer before July 23, 2024, 12.5% transfer on or after July 23, 2024.
Section 115AC, income from foreign currency bonds or GDRs.
Covers interest on bonds of Indian coast, foreign currency purchased, dividend on GDRs, LTCG from transferring such bonds GDRs, rates, interest dividend, 10% LTCG, 10% transfer before July 23, 2024, 12.5% transfer on or after July 23, 2024.
Any deductions? Indexation, return filing.
No deductions, 2844C, 57 VIA, no indexation or foreign currency computation for LTCG here. Optional return filing, not needed if only this income and full TDS deducted. GDR definition is specific, involves overseas depository bank, shares of Indian listed co., etc.
Section 11580, specified funds or FII, income from securities capital gains. This looks comprehensive.
It is. Covers specified funds or FIIs. Rates vary. Income from securities, not 115AB units, 20%. Interest on certain notified bonds, 5%. Distributed interest on BizTrust SPV, 5% distributed dividend from BizTrust SPV, 10% STCG on securities, 15% LTCG on securities, that's 112A 1.25L, 10% transfer before July 23, 2024, 12.5% transfer on or after July 23, 2024. Other income, normal rates.
Is there a nuance for specified funds here?
Yes. For specified funds, these rates apply only to income attributable to units held by non-residents, not Indian PE. They need to file an annual statement. Surcharge rules are complex, often capped at 15% for specific 115 AD incomes, even if total income is very high. And critically, surcharge and HEC don't apply to a specified fund for income from securities under 115 AD 1A.
Deductions. Indexation.
No deductions. 2844C, 57 VIA for income from securities capital gains under this section. But VIA available for other income. No indexation or foreign currency computation for capital gains. AMT doesn't apply to specified funds.
Let's quickly rerun the tax calculation for that style Inc. FAI example, AY 2025-26, to ensure we have the rates right based on the source's application. Total income was $47,080,000.
Okay. Tax calc based on source example application. Tax at 20% on dividend 6.2 L plus interest 17.32 L. Tax at 10% on LTCG, JLTD bonds, shows 10% of 15 euros, 17.3 euros for 70,400. Tax at 10% on LTCG, JLTD bonds equals 10% of under 15 euros. Source use 10% here, a specific bond rate likely applied. Tax at 20% on STCG, ELTD listed shares, STT paid 20% of 4.6 euros, 92,000. Source use 20%, overriding general 15% STCG rate for FIIs in this example. Tax at 30% on STCG, MLTD unlisted equity shares equals 30% of 4.68 euros, 1,040,400. Normal rate for this type of STCG.
Total tax before cess was 4,080,912, rounded to 8,086,912. Rounded to 8,086,910. Follows the source examples rate application.
Got it. Section 115 BBA, non-resident sportsmen, sports associations, entertainers.
Yes. Covers non-citizen, NR sportsmen, athletes, income from participation, ads, articles in India, not betting wins. NR sports associations, guaranteed amounts for games in India. Non-citizen, NR entertainers, performance income in India.
Tax rate, deductions, return
rate. Flat 20% plus surcharge plus HEC. No expenditure deduction allowed. Optional return filing. Not required if only this income and full TDS deducted.
And the crucial point about referee umpires.
Courts ruled they are not sportsmen under 15 BBA. Their income tax at normal rates under 15 BSC. TDS under 195 applies, not 194E.
Let's quickly compare tax for Smith, NR. Scenario 1. Cricketer, income 6.1, order under 115 BBA, Euro 20K horse race. Tax, order 1,033,120. Scenario 2. Match referee, income 6.1A or normal rates, order 20K horse race. Tax or order 22,360 head. Huge difference.
Massive difference. Shows the importance of correct classification.
Section 115JG, conversion of Indian branch of foreign bank into subsidiary.
Provides for tax-neutral conversion under RBI scheme. Capital gains on conversion are exempt. Central Gulf can modify Act provisions for subsidiary regarding depreciation, apportioned, loss set-off, branch losses deemed subsidiaries, actual cost, WDV transfer, tax credit, branch credit deemed subsidiaries, VRS amortization, bad debt provisions.
Consequence of failure.
If conditions aren't met, capital gains exemption withdrawn. AO can recompute. Section 154 applies. 4-year limit.
Okay, let's cover withholding tax, TDS, quickly. Section 192, salary.
TDS applies if services rendered in India. Employer can pay tax on non-monetary perks. Deferment of TDS on ESOPs for eligible startups.
Section 194E, sportsman.
TDS at 20% plus surcharges on income under 115 BBA. Deducted on credit or payment. Remember, not for referee umpires. They fall under 195.
Section 194 LEB, interest from infra-debt fund.
TDS at 5% plus surcharges on interest paid by notified IDF to non-corporate NR's foreign companies.
Section 194 LEC, interest from Indian CoBiz Trust.
TDS at 5% on interest for foreign currency borrowings. Loan agreement July 1st, 2012, June 30, 2023, or long-term bonds. No TDS if interest exempt, for example, under 104C.
And the relief from higher TDS 206AA if PAN missing.
Yes, for certain payments, interest royalty, FTS, dividend, capital asset transfer to non-corporate NR's foreign COs, higher TDS under 206AA doesn't apply if they provide alternate details, name, address, country, TRC. Big relief.
Section 195, the main one for payments to NRs.
The catch-all. Any person responsible for paying any sum chargeable to tax to a non-corporate NR foreign currency must deduct TDS at rates in force.
Can the payer get a lower rate certificate or the payee?
Yes. Payer can apply to AO under 195.2 to determine taxable portion. Payee can apply under 195.3 for nil or TDS certificate, Form 15E. AO considers various factors.
And reporting is required even if not taxable.
Yes. Under 195.6, payer must furnish info for any sum paid, taxable or not.
And that refund mechanism for the payer if TDS was deducted wrongly or in excess, for example, DTAA rate lower.
Yes, under 239A in circulars. If payer bore the tax and claims none was due or excess deducted as prime price of due to DTAA, they can claim refund. Conditions apply. Income didn't accrue or wasn't taxable lower rate, deductee hasn't filed, return time expired, undertaking given corresponding expense disallowed for deductor. Crucial practical relief.
Section 196A, income from MF units.
TDS at 20% plus surcharge on income from units payable to non-corporate NR's foreign coasts. Lower DTAA rate if TRC furnished.
Section 196B, income from offshore fund units.
TDS on income LTCG from units, 10%. Income in LTCG pre-July 23, 2024, 12.5% LTCG on after July 23, 2024, plus surcharges.
Section 196C, income from foreign currency bonds, GDRs.
TDS on interest dividend LTCG, 10% interest dividend in LTCG pre-July 23, 2024, 12.5% LTCG on after July 23, 2024, plus surcharges.
Section 196D, income of FII specified funds from securities.
FIIs. TDS at 20% on income from securities, not capital gains, lower DTAA rate with TRC, specified funds. TDS at 10% on income from securities, not capital gains or exempt income. All right, last lap, miscellaneous provisions, section 173, recovery from NR's assets.
Less tax recovery on NR's chargeable income from Biz Connection, Indian property asset source, transfer Indian capital asset, not just via TD Sagent, but directly from any assets of the NR that are or may come within India. Broad power.
Section 285, liaison office statement. NR, operating via liaison office, not a PE, must file annual statement with DGIT, entail tax, verified by consignatory.
Section 285A, reporting by Indian concern for indirect transfers.
Indian concern must report if foreign entity holding Indian assets, value 10 CR and 50% total assets, undergoes change causing indirect transfer. Penalties for failure, 2% of transaction value or 5L.
And finally, Section 163, agent of non-resident.
Defines who can be treated as an agent. Someone with a business connection, someone receiving income for NR, NR's agent in India, trustee guardian manager, or someone who acquired Indian capital asset from NR.
Agent can be NR, hearing required, representative assessee.
Yes, agent can be NR. Reasonable opportunity of being heard must be given before appointment. Once appointed, they are representative assessee.
Yeah.
That's what's 160. With same duties, liabilities as the NR, tax levied recovered from them. Ensures resident point of contact.
We did it. An intensive deep dive into non-resident taxation, from residency rules to deemed income, presumptive schemes, special rates, withholding taxes, and more. Our goal was that exam-oriented summary, leaving no stone unturned. Hope you found it clear.
Absolutely. We covered a lot of ground. Understanding these rules, as you said, isn't just for tax pros. It's vital for anyone touching global finance, investments, or just living across borders.
And as we saw repeatedly, the smallest detail, a specific number of days, an income threshold, an exception, the wording of a condition can completely change the tax outcome.
It really can. So reflecting on everything we've meticulously unpacked today, what single detail or nuanced condition from this deep dive do you, the listener, think could most dramatically alter a non-resident's tax outcome, and why?
A great question to ponder. Let that sit with you as you continue exploring the fascinating, complex world of international taxation.